What does it mean when traditional safe havens like gold surge and Bitcoin rises alongside them? Could this signal a deeper shift in how investors view risk and what assets might benefit next? Today we break down Bitcoin's explosive rebound, the factors driving it, and the ripple effects for crypto stocks and the broader market. September is often a difficult month for markets, and this year was no exception. The US indexes barely moved on September 29th, with the Nasdaq up just 0.5%, the S&P 500 up 0.3%, and the Dow up only 0.2%. But while equities struggled, Bitcoin surged more than 3% to around $114,400. That move stood out because the crypto market had just endured what many called Red September, a month that wiped out $162 billion in value due to liquidations and capital flight. Against that backdrop, Bitcoin's rebound showed clear buying conviction. It wasn't just Bitcoin itself. Crypto-related stocks rallied sharply. Robinhood jumped over 12%, CleanSpark gained about 15%, and other names like MicroStrategy, Coinbase, Marathon Digital, and Riot Platforms all rose between 5 and 7%. That combination of Bitcoin strength and equity outperformance suggests optimism is returning to the crypto sector. So why did Bitcoin suddenly act more like gold than a speculative asset? The answer lies in Washington. At the time, the probability of a US government shutdown had climbed from 72% to 82%. That rising risk weakened the dollar, pushed treasury yields down, and drove investors toward non-sovereign safe havens. Gold hit a record $3,860. Bitcoin climbed in tandem, reinforcing its reputation as digital gold. The correlation between the two assets has strengthened in recent years, ranging between 0.6 and 0.8. Both benefit during times of inflation and fiscal stress. The logic is straightforward. When confidence in the dollar and treasuries erodes, capital seeks out scarce, censorship-resistant assets. Traditionally, that has meant gold. Increasingly, it also means Bitcoin. High-net-worth investors and institutions are now allocating tactically to Bitcoin in response to sovereign risk. Macro forces are not the whole story. Positive corporate news gave crypto stocks an additional push. Robinhood, for example, announced a milestone in prediction market trading volume, which boosted investor confidence and forced a revaluation of its growth potential. These types of corporate catalysts can amplify broader sentiment, helping related equities outperform Bitcoin itself. From a technical perspective, Bitcoin had dipped to around 108,600 before the rebound. The key psychological level of 110,000 held firm as support. This level had once been an all-time high, and after the breakout, it became a foundation for institutional buying. When the market failed to break below it, liquidity flowed back in, fueling the rebound. The next resistance is near 120,000, where a prior double-top pattern formed. Right now, Bitcoin appears to be forming a double bottom with a neckline around 117,875. If it breaks through that neckline, the target could reach 127,000, implying more than 20% upside from recent levels. Technical indicators back the bullish case. The price sits above both the 50-day and 100-day moving averages, the RSI is above 60, and the May CD has flashed a bullish crossover. The caveat is volume. The rebound from 109,000 lacked heavy trading, which means momentum could fade without stronger participation. If shutdown risks ease, bulls may push higher. If those risks intensify, a retest of 108,000 remains possible. When you combine the macro safe haven trade with micro-level corporate catalysts, you get a clearer picture of why Bitcoin surged. On the one hand, shutdown risks pushed capital toward assets outside the dollar and treasuries. On the other, companies tied to the crypto ecosystem showed tangible progress that boosted investor confidence. Together, those forces helped the crypto market find a structural bottom after September's turbulence. Bitcoin's rebound underscores its dual role in today's market. It is both a high beta risk asset and a hedge against sovereign instability. That combination makes it unique. For investors, the key takeaway is that Bitcoin is no longer just a speculative trade. It is behaving more like a core alternative asset class with correlations to gold and sensitivity to macroeconomic shocks. Whether the next move is up toward 127,000 or down toward 108,000 may depend on political outcomes in Washington. But the bigger trend is clear. In times of fiscal stress, Bitcoin is proving itself as digital gold, and crypto equities are offering leveraged exposure to that narrative. For American investors weighing portfolio diversification, that is a development worth watching closely. If you found this breakdown helpful, hit like, subscribe to Trading Key, and let us know your thoughts in the comments. We'll see you in the next one.